There is a gap in this country between people who want to own a home and people who can actually access the financing to do it. And sitting inside that gap is one of the most overlooked opportunities in note investing. Today, I have someone on the show who operates right at the center of it. And by the end of this conversation, I think you're going to see this space completely different. Welcome to the Wealth with Notes podcast. I'm Sierra Davis, a private fund manager and asset manager in the note investing space, and wife, a mom, born and raised in Kansas City. And this show is about one thing: building wealth through private financing and note investing. The real mechanics, the real deals, the real story behind what it looks like to be the bank instead of the borrower. Some episodes it's just going to be me. In some episodes, I bring in people who are operating in this space and are generous enough to pull back the curtain on what it actually took. Either way, you're going to walk away with something you can actually use. Let's go. I have with me Alden from Win Mobile Homes based in Arizona. Alden, welcome. Tell us who you are and how you ended up doing this work.
Well, hey, thanks so much for having me on the channel. Great to connect again. I'm Alden Guajardo. I'm Vice President and Partner in Win Mobile Homes, and we've vertically integrated in manufactured housing to provide passive returns in seller finance notes. So not only do we operate in a fix and flip strategy in a niche market and one of the most needed asset classes in the nation in manufactured housing, but also provide capital investors positions outside of maintenance, management, insurance, and taxes. So just happy to be here today.
I love that. So let's start here because I think this shapes everything else we're going to talk about today. There is a stigma around manufacturing housing that keeps a lot of people from ever seriously looking at it. And so, what does the average person get completely wrong about this asset class?
Yeah, great question. A lot of people put their nose up at manufactured housing. They think it's trailer park trash.
Mhm.
And depending on, what part of the country someone may be located in, it obviously has a different picture and different environment. Here in Arizona, these are institutionally owned mobile home parks. BlackRock, Blackstone, Warren Buffett, Vanguard, they're all buying institutionally graded manufactured home communities, ultimately lifting the value and pushing that negative connotation towards the wayside. The buyer for a manufactured home is far different than what previously was. As the individuals who were previously buying manufactured housing have been priced out of the environment, where now average purchase prices, interest rates, and rental rates have pushed people into looking into alternatives. Where is that? That's in manufactured housing. So to see the industry experts and magnates tipping their hat and taking larger bets into the asset class, like Warren Buffett's investments in Clayton, Cavco, 21st Mortgage, Vanderbilt Mortgage, Sun Communities. That's kind of showing writing on the wall where the market's going. I think across every major news platform, they're quoting affordable housing as an issue. People are trying to figure out how to get ADUs permitted and zoned correctly for their current markets. They're trying to come out with 50-year mortgages. They're trying to do all kinds of creative stuff, print more money, and all the above, where manufactured housing is really not even talked about in most cases. So to see the new dynamic because of the need for alternative housing, I think should have individuals maybe second guessing or even taking a second look, into the solution that manufactured housing provides.
You mentioned institutional grade parks. Are these like nationwide or in their pockets? How do you describe some of that institutional feel across America?
So I'll speak to my current market,
Mhm.
here in Arizona. We buy and flip 75 homes a year, exiting seller finance in institutionally owned communities by CalAm Properties, Equity Lifestyle Solutions, Kingsley Management, Roots Management, Treehouse Group. I come to find out those are $100 million companies. CalAm's a
Mm.
billion-dollar business, and they own a portfolio across the nation at the end of the day. So to be touching individuals like that and having corporate relationships with them to see their moves, into the back office of how they're operating is quite eye-opening. So we've built up a great relationship with them, knowing that they're in the long-term investment strategy into owning mobile home parks at the end of the day.
I think that's really powerful, and to think about it, especially as an investor, where the trends are, where the markets are headed towards. So there are millions of people in this country, like you mentioned, who want to own a home and cannot access like conventional financing or affordable housing. From a pure investor standpoint, what does that gap actually represent in terms of like the opportunity?
That's where the rubber meets the road at the end of the day. Because if we can position a highly undervalued and misrepresented asset out in the market and position that now to be a turnkey home where someone matches or beats market rent in my specific market, that becomes a stable investment strategy, right? Because of the demand and the need for this actual product and the limited availability of even someone to finance these types of homes. That's where a capital investor positions himself in a much needed solution in a huge problem and ultimately getting paid for it at the end of the day, where we position not in owning the homes but at the top of the capital stack in a real estate note investment strategy. So as we combine real estate notes, right, which is widely known as the safest investment strategy in all real estate investment at the end of the day, and combine that with now manufactured housing, a new solution to a new problem, that's where high return and safety stability is had. If we can position the same dollar amount in comparison to a real estate investment strategy, say a $500,000 home, they take that same $500,000 and they go buy 10 notes for 50,000 and they make double the net operating income annually on the yield of the paper. That really starts to, I think, open the eyes and ears of individuals that are suffering a problem. They can't find passive returns out in the market. You can't just go buy a single family residence and rent it out right now. Cash flow is literally non-existent at the end of the day. So for the capital investor, when they have these issues and problems, it's time to kind of look into the alternative. Alternative investments are being Googled now more than ever. And I think this positions right in the middle of all of that.
Yeah. So basically, what you're saying is that the demand is there and the buyers exist for this particular asset, and it's going to beat rentals. And being at that top of the capital stack is the number one thing that people can do.
What's the average return on a long-term rental strategy? Net operating income on a long-term rental is probably 6%, depending on the market. How quickly you get it rented, what kind of turnkey environment you had to provide. What's average appreciation nationally? Like 3 to 5%. So on a good year, if everything were to go right, you made 8, 9% on your money. Well, most people care to argue right now that over the next 5 years, they may be little to no appreciation, right? And with rental rates plateaued really here in my market and somewhat nationally, depending on what area, some have even decreased. That presents an issue at the end of the day. Well, if you position your capital, like I said, and take that same money that you were looking at buying a negatively cash flowing single family residence, now you just started participating with no maintenance, management, insurance, and taxes, and your yield stays your yield at the end of the day. You didn't net 3 to 5%. You made, upwards of a double digit interest rate depending on how you acquired the note. And that's really the definition of financial freedom, in my
Yeah.
opinion.
Absolutely. Yeah. And so I think that is important for people to know that this type of investment exists and you don't have to go to rentals or anything like that just to um, get that financial freedom.
And why do people lean into those strategies? Well, because they're the most publicly available education that people provide. They go talk to a REO agent, they go talk to a real estate agent, they go talk to their FA. They're not in the business of return on investment. They're really in the business of advising you of what the tools that they have available. And there's no harp on them at the end of the day. But if you open your eyes as a capital investor into the alternative and wade the water, get some formal education or hitch your cart to a qualified operator, I think not a lot of people have that arm, that extending arm or that curiosity to go find the alternative investment into real estate notes. It's not as publicly educated by any means.
Yeah. Yeah. I want to talk a little bit more about this aspect. People assume manufactured housing borrowers are high risk. And what does the actual payment behavior tell you about someone who had no other path to home ownership and finally got one? What does that actually look like?
With the underwriting criteria for every note that we originate, what does that look like for someone coming to the table? They can't qualify for a single family property because it's $400,000 on average, and they make less than $80,000 a year with debt. If they made 80 with no debt, they may be able to qualify. But that individual now comes into the equation, sees a turnkey product, and how do they qualify? Well, first they go through the park, a case unique to manufactured housing. It's almost like an HOA, but a little bit higher in requirement, right? They have to hit specific credit criteria. So, like a 600 plus credit score or ITIN number, no past criminal convictions, which in single family residence, you could have a felony or something of that nature. No past evictions. You could have an eviction if you bought a single family property, and no open bankruptcies with verifiable income. So, that's the first round of underwriting. They went through the park. That's a third party, has nothing to do with me other than my home being in that community. Once they get through that benchmark, they go through Dodd-Frank compliance. What does that mean? That means it's a compliant note, and the buyer hit ability to repay. A licensed mortgage officer originated the loan, creating a bank quality asset. So in comparison to a real estate note, they actually go through an extra criteria to hit the satisfaction of our risk mitigation. What's our default rate? We've done 400 seller finance transactions in the Arizona market, wide variety of family parks, 55 and older, smaller units, larger units. With our underwriting, we've facilitated and still carry a 2% default rate, which is pretty good at the end of the day. It's not zero, there's risk in investment at the end of the day. But in comparison to, say a 20% default rate, that I think people have that higher level of default connotation just because it's manufactured housing.
Yeah. So what you're basically saying is the risk profile is actually mitigated from what people already assume.
We're not just selling a note. I'm not here to sell you one note. I'm not some schmo, just trying to get my money and disappear. We have branding online. We do weekly masterminds. I'm in it for the relationship at the end of the day. So to know that I treat every dollar as my own and protect it as such in order to keep a relationship, that I think translates what we're trying to accomplish. If I can risk mitigate that transaction to the best of my ability and treat it like my own money as I sell the note or I raise against it or I raise in my fund, that investor is going to go tell Aunt Jenny, Uncle Joe, hey, this guy packages them at benchmarks. He risk mitigates it. We know where to find them. He's got branding online. That's all extremely important to build trust because people do business with the people they know, like, and trust. So to have that borrower profile and have every one of them hit those benchmarks is really, I think, eye-opening for a lot of people.
Absolutely. Walk me through what, the numbers actually look like on a manufactured home, a seller finance deal.
We just absorbed La Montaña Lot 129 into my fund at a $96,500 unpaid balance, right? So that buyer borrower paid, I think it was like 103,000. They put a couple thousand down with skin in the game, double qualified at 96.5 with an unpaid balance. We'll finance for a 20-year term, 96.5, 20-year term, paying 11.99 a month. At 96.5, with in comparable investment strategies, where can you find a $1,200 a month cash flow with a $96,500 acquisition. So we have about 27 of those positions in my portfolio, yielding about 19,000 a month in passive cash flow. Average sale of a manufactured home is 50 to 120,000, right? And they put 10 to 20% down at any given time, sometimes less, depending on their credit criteria, how they were underwritten. So, skin in the game, affordability in the unpaid balance, and the buyer borrower matched or beat market rent. So, if that individual has little to no other options on the available market for housing, that really lifts the security, stability, safety, and potential of long term performance within that note. So, super happy and excited about that one in particular.
That's awesome. A lot of people are looking at markets that are high, California and New York. This might be something that they could afford to get into and maybe, acquire a manufactured home and then sell it on seller financing. So it's great to hear that aspect, and it's important to kind of share that experience.
Yeah, to navigate this business, there's little to no competition for people that are operating seriously. There's some other people that are operating, to say the least, but to get that additional gasoline, for the operator to figure out how to package these notes in a way, underwrite them in a way, have a mortgage officer originated and build up a marketing platform for investors to buy your positions. That's really where the cyclical processes start to hit. You can go buy a mobile home and try and sell it, but really your limited options for that buyer borrower to get financing or pay cash really hinders the equation. And as the operator, if you go sell or finance 10 homes, you just ran out of money. Yes, you just buried money in great cash flowing assets, but you have this business that's churning out bank quality collateral. No, so for the people that may be watching nationally to figure out how to implement those tools, bells, and whistles, we may be able to help you implement further strategy for liquidity within the seller finance ecosystem in manufactured housing.
That's absolutely amazing. I think this brings me to like my next question, as far as like if someone is listening to this and is a note investor and they want access to the kinds of notes that you create, what does that relationship actually look like, and how do you get into your deal flow?
Yeah, so mobile mailbox money, mobile home mailbox money, mobilemailboxmoney.com across Facebook, YouTube, Instagram, TikTok, a couple other platforms. That's where we educate and bring notes to private investors, right? So we have a once a week mastermind on Thursdays for free at 1 o'clock, currently Mountain Standard Time, and that's free. We go over our deals, talk about live due diligence, and you can get a first-hand look at the notes that we have available. Those notes end up going on our website. So if you can't make the mastermind, you could surf available positions across mobilemailboxmoney.com. It Most people don't know you don't have to be accredited to buy a note. Anyone could buy a note. Am I going to sell a note to anyone? That's not the case. We want to make sure that you're intelligent and know what you're doing before I just sell you a position. But that's where non accredited and accredited investors that are maybe higher intelligence using advanced note strategies to borrow against, they're looking for deal flow. They want to hypothecate positions. They want to give their investor 8% and they want to make 4 or 5, with none of their own money. That's mobile mailbox money. If someone were accredited, we've now escalated our ecosystem into a Reg D 506C fund where accredited investors can earn a 10% return for a 1 year term paid monthly or 12% return for a 3 year term paid quarterly. And that's across multiple positions. They become a per unit owner share in my portfolio and effectively hitch their cart to one of the largest qualified operators in the nation in the asset class.
Definitely appreciate you for sharing, and I definitely put the links in the show notes for sure. We're talking about this as an alternative investment path, and if there are people still thinking about wealth the way most people do, like stocks and maybe rental property someday, that traditional path, what would you say to that person about why thinking like a lender changes everything?
Most people don't know you can buy a mortgage. And for someone that may be busy, they're making a high income on a W 2, they don't have the time to go out and find, a savvy investment on the available market. They're being told by their FA who's managing capital, taking a percentage, to go to the stock market, mutual funds or bonds. This is really not for 100% of your portfolio, it's a portion, right? The availability to diversify into notes just like this that we provide is non-existent outside of what we have to offer. There's a couple other case specific operators that operate around the nation, but this is truly a needed product, I think, within people's portfolio because of the income oriented investment strategy. People are struggling for income. Retirees are trying to figure out how to continue to live their life on the money that they have and are tired of the fluctuations in the stock market. Listen, every tweet has an impact nowadays. If you're older or really just don't have the time to pay attention, that's a note investment strategy. And there's not that many notes at the end of the day out on the market. You got to find an operator, build relationships, get some formal education to feel confident. For the passive investor, they don't have time to do that kind of stuff. That's where we come in.
One of the things that I like to ask, as far as like this particular industry, what have you been able to do that you weren't able to do before that allows you to, do something that you didn't think that you could do?
We're called to serve at the end of the day, and I change homeowners' lives twice a week. The satisfaction I get from doing that, and not only that, but the return on investment. I think I was placed to be here, so all glory to God. Being able to give back in my community and solve a much needed problem. The blessings have not failed to continue, and the availability to do that in another investment strategy is really tough. Landlording is landlording. You're not creating homeowners. I create 3 to 7 homeowners every month, and these people literally cry at closing. So with every dollar that I get in capital investment, you help change another person's life, and hopefully we
Absolutely.
could do 100 of those transactions this year.
Absolutely. Well, I appreciate you for coming on to the Wealth with Mills podcast, and we'll see you all soon.
Thanks so
Thanks.
much.